Good morning, everyone. Scott Earhart here with Insurance Agency Marketing Services. I do want to thank you all very, very much for taking time out of your busy day to join us. We do appreciate that greatly. I think you're going to find your time with us today very, very valuable. We are going to take a look at Athene's Index University presentation. I love this presentation. It is an absolute fantastic way to understand a little bit about how indexed annuities are priced, give you some insights onto how companies build them and how that can help you to give your clients a clearer understanding of what they're doing with an FIA and how it's going to benefit them and ultimately help you close more sales. That being said, in order to give us this presentation today, we have Mac Campbell, our relationship manager with Athene, online with us. Mac, can you hear us?
I can, Scott. Thanks again for having me today.
Hey, thank you for your time. I know it's a busy, busy time at Athene right now, so we do appreciate you taking some time for us. Before I turn it over to Mac, a couple housekeeping items and a few introductory slides, and then we'll get going. First housekeeping item is our phone number is there in the top left-hand corner of your screen. If there's anything that we can be doing here at Insurance Agency Marketing Services to help you in the life or fixed annuity markets, please do not hesitate to give us a call at 800-255-5055. We'd absolutely love the opportunity to be helping you. Second housekeeping item of the day is throughout the presentation, I'm going to launch a couple of polling questions. They're all going to be yes or no questions. If you would take the time to answer those, we certainly appreciate everyone's participation there. And the final housekeeping item is we're going to give you a lot of information in a short period of time here. So I know there's going to be questions. And Mac and the entire culture at Athene really are very, very good at being as transparent as they can. So if you have questions, there is a questions box on your screen. Please feel free to type those in. We will do the best we can to answer those at the end of the session. If there's a question that's a little too specific, or if we just can't get to it, Mac or I or Mac's team at Athene will follow up with you and make sure we get that answered. That being said, let's get into a couple introductory slides, and then we'll get it on to the meat and potatoes. First slide is for individuals that are new to Insurance Agency Marketing Services, or if this is your first introduction to us here at IAMS, you will be eligible for the new producer bonus. New producer bonus is based on production within your first 180 days of being licensed, and as you can see, there are 3 great levels that you could qualify at, and in each level, there's great rewards for you that you can choose from cash perks to business building tools to personal rewards. A lot of great stuff available to you there, and we certainly want you to take advantage of new producer bonus. If you'd like to dive more into how this program works, or if you would like to know where you stand or have a conversation about what we can do to get you up to the next level, how we can assist, please let me know. I love that conversation. Top Producers Escape, one of my favorite things in the entire world is getting together for one of our top producer escapes. For those, I'm sure we've got several people that have qualified for at least one of these on the line now. We call it the IAMS Family Reunion. It's a really unique experience. Mac has been to several with us, and it's just a great time. It's a really good way to get together with fellow producers. People that you know, people that you're going to get to know, have a real relaxing time and reward yourself for all of your efforts, and do it on the IAMS dime. That being said, in 2018, late February, we'll be in Scottsdale, Arizona at the Boulders Resort and Spa. If you ever want to look up, top 50, Travel and Leisure's top 50 resorts in the U.S. The Boulders is consistently near the top. I've been there several times. One of the greatest places on the face of the planet. Great spa, great shopping, fantastic accommodations, golf courses there are 2 golf courses there that are ranked in the top 50 golf courses to play in the U.S. I mean, just a fantastic locale. Steve and Charles, the owners of IAMS, spare no expense on these, so you will be treated the way you deserve to be treated. If you'd like to learn more about how to qualify for the Top Producers Escape or details on the trip, please let me know. Creative services, definitely want to make sure all licensed producers with IAMS are taking advantage of creative services here. Or if you're looking at becoming appointed with IAMS, I want you to give them a call and talk to Jen, talk to Josh, see what we can be doing to help you increase your brand awareness in your natural market. We can do that through basic marketing with logos and business cards, stationery, things like that, all the way up to creation and deployment of television. We can do it for you here in-house. I think you will be, I don't think, I know you'll be pleasantly surprised with the cost and the fact you won't give up any quality. Our entire creative team, very, very good at what they do, and they are here in-house with us every day. So if you ever need anything, all you have to do is give our office a call and we can get you into the creative department. They can help you with whatever it is you're currently working on. One of the things that we do offer through the creative team is newsletters. If you're not sending a newsletter to your current client base and your prospect base, I think you're missing out a little bit. It's a great way to keep relevant information in front of the people that you are doing business with and the people that you want to be doing business with, and keep your contact information in front of them so that the next time they have a need for a product or a service that you provide, they only think to call you. If you'd like to get more information on how the newsletter services work, please let me know or call straight into the creative team. We can certainly get you started with that. Life and Annuity Academy. As I talk about the Life and Annuity Academy, I'm going to launch our first poll of the day. And what I'm going to ask you is if you would have interest in learning more about our Life and Annuity Academy. If you click yes, it's not a commitment on your behalf to attend one. It's just saying I want to learn a little bit more. You'll get an automated email from IAMS that has an agenda for our previous academies, so you can kind of see the stuff that we cover. You'll also be sent a link to apply for attendance. We do have 3 academies on the books for 2017. The first one is coming up here very, very quickly, May 17th, 18th, and 19th, and we are beginning to send out official invitations for that. So if those dates, the 17th, 18th, and 19th of May, are of interest to you, please click yes, and we will get you out that information to apply. Now, I do want to talk real quickly about what our academies look like, because I'm sure you've heard from competitors of mine out there that, come into their seminar and you get there and it's all about product and product and product. That's not what we do here at IAMS. This is a sales and marketing summit. And what we do is we will bring in internal staff. Myself, Mark Raymakers, who is our life director, Charles Hiring Jr., who's the head of our wealth management team, members from the creative team will be there, members from our new business team will be there, and we are going to present to you on what we do to help you make your life easier, whether it's me talking about how we can help you with case design and proper funding of an annuity, going deep into income riders and volatility indices. Mark will have some great presentations on wealth transfer and multi-generational gifting, the personal banking concept, a lot of great stuff there. New business team will be there to chat with you about how we process business, how we will be your back office and take all of that off your plate. Of course, we talked a little bit about the creative team earlier. Creative team will be there to show you exactly what it is we can do to help you increase your market share through branding and marketing, mass marketing. Charles Jr. will be there to talk about, the wealth management platform and how obtaining your 65 can help you grow your business and help you navigate what could be an interesting regulatory environment moving forward, and the solutions that we have for you there. We will have our executive and ownership team there, and Steve Murray and Charles Hiring. One thing that I find very unique about insurance agency marketing services is our ownership team. They're involved. They want to meet you. They want to get to know you. They want to understand your business and make sure that we're tailoring your experience here at IAMS specifically to you so we can help you maximize your potential. One of the best things that I think we do in this training is we'll bring in at least 4 of our sales coaches from throughout the country. And to be a sales coach with insurance agency marketing services, you not only have to talk the talk, but you also have to be able to walk the walk. So all of our sales coaches are multiple time top producer escape qualifiers. These are the upper 1% of the industry as far as production numbers go. And what they will do is show you exactly what it is they do in their day-to-day business that makes them so successful, and give you the ability to take that home with you and implement it in your own practice. Now, before we move on, I'd be amiss if I didn't give the floor to Mac for a second. In May, we are going to be at Athene's home office. We're going to partner with them for this academy. We've done it in the past. I'm sure we'll do it again in the future. They're a great partner for these type of things. So, Mac, anything you'd like to add about the upcoming Life and Annuity Academy?
Sure, Scott. Thanks for the opportunity to say a few words on this topic. Listen, from my perspective, being a wholesaler for an insurance company, clearly, the benefit that we see is to get as many great producers into our home office as possible. Give them an opportunity to kick the tires, and we try to bring, to Scott's point, the IAMS senior management team will be there, as well as, of course, Athene's. So it's not uncommon for, as an example, the president of our organization, Grant Kvalheim, to help kick us off. Gives you an opportunity to see what we are about and how we operate and how we like to do business, and us the same for you. But I think from your perspective, the opportunity to talk to one another, your peers, your successful peers in the business, is really the reason, I think the primary reason that you would want to attend one of these academies that IAMS puts on. And so very collaborative effort among everyone that attends. Idea sharing that happens, sales ideas, best practices in your business, time well spent, I guess. And we'll leave it at that, Scott, and I'll turn it back to you. Thanks.
I appreciate the words and appreciate the partnership, Mac. That being said, I know we spent a few minutes on this. I'm going to close down this poll. So if you haven't taken the time to click yes or no, if you would please do so now. We will be moving on here in just a second. All right. Thank you, everyone, for your participation there. We do certainly appreciate it. Okay, paperless contracting. We want to make sure everybody is aware we have this out there. Save time, be more efficient. That subheadline there, that sums it up. We all know the pains of filling out multiple carriers' licensing forms. This takes that away. We can put you on a platform where you can add a company simply by clicking a couple of buttons. If you would like to learn more about how the paperless contracting or efficient forms platform works, please give Chris Mount, our licensing director, a call. She's an expert in it. We can get you on that system and get you saving time and being more efficient. Our website, want to make sure everybody's aware that it's out there, IAMSinc.com. A lot of great sales tools out there for you, a lot of great time-saving tools out there for you to help you be more efficient if you're working on the weekend, if it's late at night, if the office isn't open, if you've emailed me and if it's 9 p.m. Central Time and you've sent me an email and I haven't gotten back to you yet, you may be able to help yourself at IAMSinc.com, and we certainly would love to have you registered there. One thing I do want to mention is if you are actively producing with IAMS, definitely make sure you're registered at IAMSinc.com. We're going to have some enhancements coming very, very soon to that website that I think you'll find very, very intriguing. IAMS Wealth Management, I mentioned this earlier when we were talking about the Academy. IAMS Wealth Management is a subsidiary of IAMS. It is a full-out RIA. If you are looking at getting your 65, if you're already 65 licensed, I'd give Charles Jr. a call. Charles R. Hiring here in our office. We're located in the same building. He has a separate phone number. He and Mike do 888-255-7670. I think that we've got a lot of great tools. I know we have a lot of great tools to help those of you who are studying for your 65 or considering studying for your 65. We can certainly help you get as prepared as possible to take and pass that exam. Also, if you are currently an IAR, I'd implore you to give Charles a call and learn a little bit about our fee structure. I think you'll be pleasantly surprised, and your clients will be pleasantly surprised in comparison to what you're looking at right now. Retirement Analyzer, this is a great tool, and this is going to be a great tool moving forward in our business. It gives you the ability to show your client exactly how long their money will last into retirement, making some very conservative assumptions. Um, and it's a very client-friendly piece, graphs, line charts, that is very easily understood. Also, it does give you the ability to input products or services that you're recommending the client utilize and show them exactly how that will benefit them as they move closer to their retirement years. Marcus Solar in our office is the point man for the Retirement Analyzer. If you have questions, if you'd like to take a look at it, if you'd like to see a free demo of it, please give Marcus a call. He's absolutely more than happy to walk you through it. I believe this is my last slide before I hand it over to Mac, and one of my favorites, marketing reimbursement and referred producer program, all about putting money back into your pocket. Start on the right-hand side with marketing reimbursement. Rough numbers on marketing reimbursement: for every $100,000 in FIA premium you place through IAMS, $200 goes into your marketing reimbursement account. You can utilize this account at any time for any business expense. All you have to do is submit a receipt to us and we'll cut you out a check. If you'd like details on how the program works, certainly I'd love to have that conversation. Or if you'd like to know how much is in your marketing reimbursement account right now, all you have to do is ask. Usually I can get you that number same day, if not next business day. Left-hand side of our screen is referred producer program. Our business on the wholesale side of the industry is really, really similar to yours out there in the field, in that one of the best leads we're ever going to get is a referral from one of our valued clients or you, our valued producer. So we want to make it worth your while to refer other producers to us. When you refer an individual over to us and they pick up any license through Insurance Agency Marketing Services, we're going to send you out a check for $50. Just to thank you. Appreciate that. Now, where the real money comes in is as your referral writes business, you're going to get a 20 basis point override on that. We cut these checks at least quarterly. I know from seeing them, Steve and Charles sign checks for thousands and thousands of dollars at a time. So it can be very, very lucrative to you. If you have any questions on how the program works, please let me know. If you have anyone that you think could benefit from doing business with Insurance Agency Marketing Services, please, in the questions box, type in their name and any contact information you have for them. I'll do the best I can to get them recruited over and hopefully get you on your way to earning some referred producer dollars. That being said, I am at the end of my slides, so Mac, I'm going to give you control.
Great. All right, great. Thanks, Scott, for the great introduction. And if you would, as usual here, just verify that you can hear me okay and that you're seeing that first cover slide that says Athene Index U.
Absolutely, I can hear you and we can see it.
All right, terrific. Thanks again, Scott, for having me, and to all you on the phone listening, thanks for your time. We'll take about the next half hour and kind of go through the content here. This is going to be a little different. And Scott had mentioned that there's a lot of product webcasts out there, and listen, we do our fair share of those. I think that's important. But I think what's also important is understanding how these things work. And we're talking about indexed annuities, and I think it's great to kind of go back to the basics and discuss why indexing is good and valuable to clients. And as we've seen over the last 10 to 20 years, indexing methods and strategies have really morphed and changed and developed and innovated. And there's a lot of moving parts. And I think one of the most dangerous things that any carrier can do is to assume that clients understand exactly what they're buying. And this kind of content is going to be very shortly available to you on our website that we've got to kind of educate you and ultimately customers with client-approved material. What is indexing? How does it work? Why does it work? And then ultimately, we're going to get a little more advanced and discuss some of the new strategies we're seeing that are being developed today. The volatility control indices, a lot of these are on caps. So that's kind of what we're going to cover. A lot of this content might be reviewed, at least initially, as we go through the first few slides, but I like the content because I can see customers learning in this way as well. So feel free to kind of use this content, jot down notes, and certainly this would be great on a yellow pad in front of a customer, I believe, or a prospect. So just a quick look at the agenda, what we're going to cover, really three things. a quick look back at the basics of indexing, why it works, why we like it. We're going to talk about what an index actually is, because ultimately that's what drives the value for clients in these products. And then we'll close with discussing the evolution of indices in the fixed indexed annuity space. And listen, it's been quite an evolution, dare I say a revolution, over the last several years, with just an explosion of all these alternative indices that are out there. A lot of them very valuable, but again, a lot of moving parts. So I want to make sure that people understand exactly how they work. So if we take a quick look at the annuity spectrum, and this is really a spectrum of risk. We've got lower risk on the lower right, and of course higher risk on the upper right. And we've got an income annuity or straight SPIA. Clearly there's no risk there. I guess the one risk is if you don't live long enough, potentially the carrier would get the money. But for all intents and purposes, those are virtually no risk annuities. And of course, fixed annuities have a guaranteed rate of return. And up to the right there, we've got our variable annuities. And what's interesting is we're starting to see, I think this was the last year or first year rather, we've seen sales of variable annuities go down, which very unusual. I think that is very, very telling. I think people are thinking the market might be near its high, possibly. Who knows what's to come down the road. But we're starting to see sort of this convergence to the middle, where we believe the fixed indexed annuity fits perfectly. The way it's priced these days, it can provide a lot of value for clients, even when interest rates are as low as they still are, although we have seen a little bit of a rebound. And then, of course, the variable annuity discussion we just talked about. Oftentimes, those are very expensive. And, again, there's a great degree of risk there. So we think the fixed indexed annuity kind of fits right in the middle there quite perfectly. And we're starting to see really the dollars typically going in these income and fixed annuities and variable annuities into the fixed index space. And it still continues to be a very fast growing market segment. So kind of three parts to, I guess, looking at the benefits of a fixed indexed annuity. First is the protection, sort of that dark blue dot in the middle there. Your absolute downside protection from market risk. And then around that, there's some degree of guaranteed growth applied. Some apply that guarantee along the way. Others, a more popular design is to apply a guaranteed growth rate at the end of the surrender term if it's needed. And then ultimately, we've got that sort of a yellow outer circle of potential growth that are based on, in part anyway, on the performance of some market index, be it the Dow Jones or one of the most popular indices even today, the S&P 500, which we'll discuss more in a moment. So let's, in its basic term, discuss how a fixed indexed annuity works. So let's go from left to right here. Starting on the far side there, number one, this represents just any index. Pick your favorite. I mentioned the S&P 500. We'll use that. What goes up often goes down. We saw that in 08, 09. We were seeing quite an uptick these days, which is great for everybody. Who knows what's to come though? The underlying index, as we know, it may increase or decrease in value. Now, number two is how the indexed annuity is designed. That phrase that you've likely heard in our business if you've been selling indexed annuities over the last several years, zero is your hero. Effectively, what we mean by that is that the carrier takes the downside risk. And we're able to do that because we purchase options on the index to kind of hedge our risk there. Now, going to the right side, number three, because the insurer takes on all the risk of the downside, we're going to limit to a certain extent what the customer gets on the upside. So that, we see caps, we see spreads, we see participation rates. And that's really the three popular varieties of crediting interest to indexed annuities, really. I think the most traditional and widely known is the cap. We've got a spread, as I mentioned, and of course, participation rates. I'm not going to go through each of these. You'll likely know what we're talking about when I say cap, spread, or par rate. But here's just a few examples of if a particular index earns a certain rate, and there's a cap, what it's capped out at, what the spread is, and what the participation rate, ultimately what the return would be. The point here is these strategies are designed to work in different market environments. And this is why I think it's important as you're looking at a annuity or a carrier with indexed annuities that they give you choices. Ideally, you want a product that has complementary strategies because not every strategy will work the same way in different markets. So let's kind of get into this idea of what an index actually is. And we've kind of talked a little bit about it. It's simply, if you look it up in a dictionary, it's a measure of change in the securities market. It's a basket, if you will, of securities representing a particular market or at least a portion of it. These are most often used in mutual funds, ETFs, of course, annuities as well. And examples you see there on the left, the Dow Jones, the S&P are very widely recognized and used. A lot of numbers and lines on this chart. This kind of does a couple things. The dark blue line there actually represents the S&P 500, the pure S&P 500 index, and you've seen how that's gone up and down over the last 10 years. And the three other colored lines on the chart there represent three different strategies that Athene has in its products. And it kind of shows you how these volatility type control indices, some actually based on the S&P 500, how they behave in different market environments. And again, I show you this to kind of tell you that there isn't one best crediting method. The reality is, depending on what the market looks like at a given year, it's oftentimes impossible to predict what's going to do the best. And again, makes sense to have options for your client, and the ability to actually participate in more than one option as well at any given time, I think makes a ton of sense. So let's talk about the Standard & Poor's, or the S&P 500. This is really the bellwether index in our indexed annuity space, and really has been since, believe it or not, the mid-90s, when these things first appeared on the scene. It's a broad-based composite of large cap U.S. companies. It's the most easily recognizable, easily quoted strategy, so customers love it. I think producers love it for that fact as well. Believe it or not, even today, over 50% of all indexed annuity crediting strategies in the marketplace still are based on the S&P 500. So far and away, the most popular. And again, I think it makes sense. It's recognizable. It's been around a long time with actual returns to look at. So I think that makes sense. This is kind of interesting though. If we go back 5 years ago, or a little over 5 years ago, first quarter 2011, you can see the dark circle that represents the S&P 500. This is the 7.1 billion was the amount of indexed annuity sales in that quarter, by the way. And this kind of shows you where those premium dollars went. 2/3 of it to the S&P 500 strategies, actually a healthy chunk to the fixed account. You'll notice that the alternative index space is virtually non-existent. Well, let's fast forward 5 short years later, Q1 2016, so about a year ago now. The market has doubled in that quarter, which is great. Notice the S&P still is a prevalent strategy. I mentioned that before, but look what's grown rapidly, that alternative index section, to almost a quarter of the entire marketplace. And it's an astounding rate of growth. And I think it makes, by the end of this, I think you'll understand why that makes sense. The reality is carriers have been forced to be innovative in how we can provide value to your clients when interest rates have been just historically low and kind of continue to be as well. So we've talked about sort of the basics of an indexed annuity, the whole zero is your hero mantra. We talked about what an actual traditional index looks like and what it's designed to do and provide. Now we're going to switch gears and get into what an alternative index looks like and how they operate and why they operate the way they do. So there's three parts that make up an index when you look at an indexed annuity, and we like to call them the constituents, or in other words, what's it made up of, the maintenance, and then is there a layer of risk control? Those are the three words you see on the left side of that chart. And we'll compare a traditional index like the S&P 500 that we just talked about with an alternative index. And I don't care which alternative index you want to pick, they all work generally the same way. Now, of course, they're going to be different because they have different indices supporting them. But in general, if you look at the constituents of a traditional index, that is almost 100% correlated to the index it's based on, right? If you have a client in an S&P 500 index with a cap of some sort, when the S&P goes up, so will that strategy. When it goes down, again, so will the strategy. Of course, floor is zero, as we know. But it zigs when the traditional index zigs, and zags when it zags as well. An alternative index could potentially bring a more specialized group of stocks or even other assets. And those other assets could be ones that are actually non-correlated. So when the S&P, for instance, zigs, this will zag. And that may be important if you have some strategies that are correlated and then some that aren't within one product. That could be a huge value proposition for clients to see value in really any market environment. The maintenance, really, there's no maintenance with a traditional index. Whatever the index does, client gets a portion of it. It's essentially a static maintenance program, in that there is really none. With an alternative index, oftentimes there's a formula that's rules-based that often will rebalance or reweight the holdings within that strategy. Now, the frequency often varies. We see some indices out there that will rebalance on a quarterly basis. Some do it monthly, and as you'll see here at Athene, we have one that actually does it daily, which I believe is a huge value prop for the client. And then the last thing there is this idea of risk control. With your typical traditional indexed strategy, again, like the S&P 500, there is none. Again, the risk control is oftentimes a lower cap. I mean, if you're basing an index or trying to price volatility in an actual regular index without multiple constituents or maintenance involved, volatility is often higher, and as a result, carriers got to give you lower rates there. Well, on the alternative index side, in addition to the constituents that oftentimes have more than one asset class and different groups of stocks or equities, the different maintenance programs that are involved there, there is a layer of risk control as well, and that often will differ as well. But that is there to stabilize returns for the client and the company. And I'll explain why that's important to the company in a moment. This is just a sort of a picture depiction of what we just discussed. And this is actually available on most of our client-approved indexed material. It basically describes what volatility does and how volatility control works. So if on the left we have the base index, like the S&P, let's say, and on any given day, if the volatility in that index goes up, the cash exposure will increase to lessen the exposure of a higher volatility time, and the base index weight actually decreases. And then that'll again get passed along to the client in an interest credit down the road. The opposite is also true, though. If that base index is experiencing a time of low volatility, the indexed weight will increase, the cash weight decreases, and the client takes advantage again of that low period of volatility. That's designed, volatility control in its basic sense is designed to smooth the ride out for everybody involved. That includes the carrier and the customer. So here's a perfect example of what I kind of just talked about. The dark blue line, again, that represents the actual S&P 500 index. Now, the light blue line, or at least it's light blue on my screen, not sure if your color is the same as mine or not, but the light blue or aqua line, that represents an S&P 500 strategy on volatility control. And this is one that's in our portfolio. So you can see that we just talked about how it makes sense in real world applications. Notice the S&P 500 has significant ups and downs, quite extreme in some instances. But I mentioned before that a volatility controlled version of that index is designed to smooth out the ride. And you'll see that it does exactly that. In 07, the highs weren't as high, but in 08, 09, and 2010, the lows weren't nearly as low either. So if you choose the right index with the right volatility control, you can see that the starting point and the ending point are virtually identical. But the path to get there is a heck of a lot different. And we believe that that's where the value is for the client. So here's just a quick, more specific look at what an example of an alternative index might look like. And these are two that we have in our portfolio. If you want more information on them, call the folks at Scott, on Scott's team at IAMS or my sales team. We can kind of walk you through how they work or what they're called. But one of them has 75 high-quality U.S. dividend-yielding stocks as its constituents. The maintenance employs a quarterly rebalancing or reweighting, and this has a 5% volatility control target. That's one example. Another example is one that has multiple asset classes and economies in a different equities, fixed income, and commodities, United States, Europe, and Japan. This one happens to rebalance on a daily basis, and the risk control again has that target as well. They oftentimes, if it needs to, shift into a cash position. What's interesting about this one is that because it rebalances as often as it does on a daily basis, the risk control layer is almost never tested, because when you have all those different assets and economies to kind of rebalance on a daily basis to really optimize returns, you really drive down volatility to a huge extent. So why would you consider these? Why would clients want to consider them? Well, quite simply for diversification, to be different perhaps than just your traditional index. Traditional indices have equities only typically versus an alternative one that may have multiple assets. Directly correlated to the market as opposed to non-correlated, again, zigging when this will zag. And then just providing additional index objectives and strategies to a client's portfolio that might not otherwise be available to them. And then for volatility control, this may provide more predictable returns for customers and may and should, frankly, enable higher participation in that index itself. And therein lies the value of volatility control, I believe, over a traditional index. The ability to participate more in that index because the carrier is able to control volatility to a large extent. So here's, again, just a quick graphical look at what I just said. Why settle for less upside, right? So if we know, we just said that the volatility controlled indices are never going to be as high or low, why would you settle for less? Well, again, if we just take a regular traditional index like the S&P 500, that's on the left, and we know the opportunity for those larger swings is greater, that means there's more volatility. That means the insurance company has to return it because it is more volatile with lower rates, higher spreads, lower caps as an example. When we take that same index and put it with some volatility control, yeah, we're limiting the upside potentially because we're minimizing the risk and the volatility, but the client keeps more of it. So therein, I think, is the rub. Volatility control indices can be complicated to kind of explain sometimes, but I believe when interest rates are low like they are and have been and likely will be for a while still, there's still a ton of value. I think potentially even more value than a more traditional index available for clients. So here's the carrier view on the left and the customer view on the right. And you can see they're very much in sync. So why alternative indices? From a carrier perspective, volatility controls hedging costs. And they're lower and frankly more predictable. So that allows us to give the client higher participation rates and more predictable renewal rates. And that is important. At Athene, we like to try to set our budget for each contract for the entire surrender charge duration. So that unless there's tremendously severe market dislocation out there, the client can expect predictable renewal rates. Similar, if not identical, to what they got when they bought the thing. And I think that sleep at night philosophy hopefully makes everyone happy, including you as the advisor, knowing that you're not going to have sort of the cliff, on the next anniversary appointment if rates go south. Carriers can offer differential customer value by developing and pricing appropriately these alternative indices, and now customers, as a result, have more choice in their indexed annuities than they have ever had before. This allows, I think, as I mentioned before, and I think as the market has borne out here over the last several years, the indexed annuities with these indices have the potential to be more competitive. And that ultimately means more upside, more safer upside for clients. So I'm going to bring this slide up one more time. We've seen this before. Again, just as a quick reminder, this is sort of looking at the S&P 500 and then an S&P 500 volatility controlled index sort of through a telescope, sort of a big picture 10-year view. Now we're going to get rid of our telescope and look through a microscope. And this is an interesting slide. Believe it or not, this is the 7-day aftermath in the market following the Brexit situation a year or so ago when Great Britain decided to leave the union there. The blue line is the pure S&P 500. That's the actual market itself. And you can see, if you remember those days, the week following, it was pretty volatile. I mean, the market tanked for a couple of days, but reason ended up ruining the day, and it actually rebounded. And ultimately, over the course of that week, people in the straight S&P, no harm, no foul. Now, again, if they had to shut their eyes and close their ears, I guess, because a lot happened during that week. Now, the three lines above that, the one just above it represents the S&P 500, again, with a layer of volatility control. So you can see that because there's volatility control involved there, the lows weren't as low. Now, it's still directly correlated, though, to the market, right? Because it is based, again, on the S&P 500. Now, I want you to look at the red line. That represents that daily rebalance strategy that's based on all the different asset classes and economies I suggested. And notice that that's not correlated. So when the market, the general marketplace zigged, that strategy zagged. So again, I don't show this to you to say that that's always going to happen, but I think it's a very interesting exercise to notice a very volatile part, in the index, and what the strategies can do. Bear with me here. I think we're having some technical difficulties. Let me just see if I can get back on. Scott, can you still hear me?
Yes, sir. I can still hear you.
Okay, great. Sorry, I had a strange pop-up on my screen. So anyway, again, I like that slide. Again, does it reflect the long-term view? Not necessarily, but like I said, it does give a good look at what I think how indexes behave in different market environments. All right, so let's move on here. So at Athene, we've got a pretty exhaustive due diligence process. When we look to develop or potentially partner with an investment bank to help design an index for us, we look at really three things. Is it a strong design? Is there a good name brand supporting the index, the value proposition? Is it a good fit? We don't want to develop an index that we already have or that works similarly to what we already have. We want indexes that complement what we have. And then ultimately, is it a solid value for the client? It's easy. Well, no, it's easier, let's say, for a carrier to pick an index based on hindsight that looks good on paper. It's more difficult to pick one that should look good going forward, and that's what we aim to do at Athene. We choose indices not for what they've done, more for what they will do for clients down the road. And this process, frankly, can take the better part of a year. We may decide, listen, we're not going to go forward, or we will, but it's a very responsible and exhaustive process that we use in electing a new index. We're going to quickly talk about an illustration situation that I want you to be aware of, and then we'll kind of close and then take any questions that you may have. And again, a lot of information that was covered, I understand that, but we're happy to answer those questions. So with the explosion of these alternative indices, a lot of them have actual histories that are pretty short. So carriers are forced to simulate returns based on current rates, what they're priced at, and looking, through 10 to 20 to 30 years of market history. And there is a lot of regulatory sensitivity to this. So you got to make sure the index you're looking at is being illustrated in a very responsible manner. So I'm going to give you an example here. And this is a loaded example, but just bear with me here. Here we've got product number one in the yellow column there, or gold column. These are income amounts. Clients 55, 10 years down the road, it generates $13,400 of income roughly. Or product number two, which starts at the same dollar amount, but only provides $9,000 over that same period. Which would you choose if you were a customer? Well, unless you didn't understand what I said, you're going to choose number one. Why would you choose a lower amount of income? The reality is, these are the exact same product. We just chose different illustrated points to illustrate them. So this goes to show that, again, be wary of cherry picking that carriers sometimes engage in when they develop an index. Like I said, it's easy to pick an index that looks good over using the benefit of hindsight. What we look to do at Athene is back test our strategies over every single market cycle over the last 20 years. So you're getting a better representation of what that thing would have done over really any market condition. And we'll close with this slide. And again, that formula at the bottom, it's, again, no one said there'd be math. I know. Basically, NCV, net customer value, equals return times participation. And that's the end of it. That's what an index strategy is designed to do. We believe at Athene that while there is value to traditional indexes, we think there potentially could be more value for the alternative space. And we're certainly getting behind that story in a big way. So Scott, with that, I will turn it back over to you and be happy to take any questions that there might be from the group.
Fantastic. Thank you, Mac. I will take back control now. We did have, I kind of jumped ahead a little bit. We do have a couple, at least really good questions that have come in. And if there are any more questions, please, while I'm talking here, type them in. We'd love to answer those for you. As we go through the questions, I'm going to launch our final poll of the day. And what we're going to ask you here is if you'd like contracting information with Athene. If you are not currently licensed with Athene and you liked what Mac had to say or liked what you saw today, please click yes. We'll get you out licensing information. If you're already licensed with Athene through a competitor of ours and you like what IAMS has to offer, please click yes. We'll get you out transmittal information, see if we can't service your needs here. But ultimately, Athene is, an industry leader. The Q4 numbers, which Mac didn't bring up, have come out, and they proved that Athene's an industry leader in FIAs. And I think from the presentation you saw today, you should realize that. That being said, Mac, we've had a couple questions come in. You ready for us?
I am, Scott. Go ahead.
Okay.
Fire away.
I really like this first question. Would rebalancing or reweighting of the indice increase the internal costs and result in lower overall returns to the client?
That is a good question. Yeah, and I guess the short answer is it depends. And that brings up a great point. Because there are a lot of different indices out there, we'll use a general rule of thumb here. What we are seeing is when a carrier signs on with some sort of an exclusive or proprietary index, heck, whether it's one like us, like BNP or Merrill Lynch or JP, just pick an investment bank. More often than not, that will be a little more expensive than will just a traditional indexed strategy, because again, there isn't that maintenance involved with it. So, yeah, could it be a little more pricey to do that? Sure. I don't know that the client would necessarily see that in their statement, because oftentimes the strategies, when you illustrate them and you see the numbers that they backtest to, and the worst case, the best case, those numbers are always net of all the fees. So that's the good news. But listen, you're right. I mean, yeah, there's certainly more of a cost there. I think, frankly, though, the client won't see those, because if they're looking at an illustration and you're using an illustration to help make a sale, those are all net figures, as I said. And ultimately, as we've said in this presentation, I think it makes sense to have an index that employs those strategies, because I think the upside is a better opportunity there. Hopefully that helps answer that.
I think it did, and thank you for that question. Thank you for your answer, Mac. And as we're talking about, upside potential for the client, that leads us into the next question that came in, and I like this question a lot too. With an annual reset, of an annuity, assuming we're in an annual point-to-point, wouldn't it be more favorable to have more volatility?
Yeah, that's a good question. I tend to agree, actually, to a point, right? So let me clarify that. I'm of the mind personally that if we're going to be looking at indexed annuities for customers, and this is not by any means, every client's different. Let's put that out there. Every age group is different. But again, this is just my personal opinion. If you're going to be selling someone an indexed annuity, why not pick a strategy that's designed to get a couple home runs? Because you're not going to lose anything, so why not? That's kind of my theory. Now, obviously, it's important you have a product that I think gives you options, right? Because not every home run strategy returns value in a moderate market. But to get back to your question about the volatility, in theory, if you look at a traditional S&P 500 index, that index has, without a doubt, the most volatility. The problem is that it's to a fault, right? Because the carrier is forced to provide lower rates. What you want to do is find, I think, an alternative index, maybe a volatility controlled based on the S&P even, that's got a volatility target that's relatively high. We see a lot of indices out there that target a 5%. That's pretty conservative. We've got a couple that are at 8%, one even, I think, close to 10. So again, to short answer your question there, yeah, I think I would like to see more volatility, because again, the higher the volatility target, the more of an equity position you're always going to have. And isn't that why we're selling indexed annuities in the first place, is for that equity position? Without of course, the pain of the downside. So yeah, I think you're right.
Fair enough. Great answer there, Mac. And, if we go out and scour the industry and look at all these volatility indices, if I were to go to every carrier we have that has one and grab them all and just line them up, you're going to see Athene rise to the top of the pack as far as the true volatility percentage goes. They're going to have options, as Max said, for you that will bring in increased volatility. And, again, to piggyback on what Max said, give your client the opportunity to hit a home run or two in that surrender period, more so than other companies that have stuck in that, low volatility range. So if you're looking for those higher volatility, go ahead.
I'm sorry. So, yeah, I don't mean to interrupt. Just maybe one more quick stop before we got on to the next question. Because the person who asked that also mentioned something I wanted to address was this whole idea of annual reset.
Mm-hmm.
So what we're also seeing, and I like this as well, is 2-year resets. And what's interesting is if you go back and you were to isolate market returns in 1-year increments and then 2-year increments, the 2-year increments always perform better over the long term because you've got more market data to potentially, or more market returns to potentially use there. That allows the carrier, because options are not as expensive the longer we go out like that, that allows the carrier to provide better rates and better participations. In some instances, you can see participation rates on 2-year strategies exceeding 100, 130, 140%. So I like mixing an annual reset with a 2-year reset. And the reason I still love annual reset, and again, I'm a little old school. I would not like going to an annual review with a customer where they have all their money in a 2-year reset and you got nothing to show them in that first year. I like the idea of at least showing them something if it's there. So I like mixing a 1-year and a 2-year strategy, frankly. But anyway, Scott, so didn't mean to interrupt there.
Oh, no, you're great. And I may end up putting the ball back in your court with the statement that I'm going to make here. I run a lot of case design for producers that I work with on a daily basis here. We do a lot with, I'm going to throw up the air quotes here. I'll call them the exotic indices, BNP, Merrill Lynch, everything we're talking about here with volatility indices. And one thing that I'd say is I have a lot of producers go, I'm scared of the 2-year because what if it falls flat on its face? And where I think Athene brings a lot of value is in the BNP and the fact that you have non-correlated assets there. If you have something's got to be going really, really wrong in not just in our economy here in the US, but in the world economy to have the BNP strategy, the BNP setup with all the non-correlated asset classes all fall flat on their face for 2 consecutive years. So I think there's a lot of value with the BNP and their 2-year strategy. And as Mac alluded to, the extremely heightened participation rate that is available out there. So if you are listening to us out there and you're a little concerned about multiple year point-to-points, definitely give the BNP a chance. At least let us illustrate it for you. Athene's got a great producer and consumer-facing site that we can get to you to kind of break down how it works. There's a lot of value there for your clients. And once they understand it, I think they'll realize that as well. That being said, Mac, I've got one last question. Well, I have multiple questions, but I'm going to throw them all into one bundle, and I'm sure you had no idea this was coming. Any commentary that you would like or are allowed to provide on the current situation with the Department of Labor?
Yeah, geez. Yeah, it's changing, right? I mean, it's. I guess we're liking the delay for sure. Listen, if you've attended one of these calls before, hopefully you've heard my commentary as it relates to Athene's position, and that position has not changed. We are willing and able to sign the BIC if it comes to that. We obviously see in the marketplace the delay that's got us till June 9th, and there's even more. Discussion about that any best interest situation that would occur even after June 9th that necessarily wouldn't be on the hook for it until the next year anyway, which is also positive. There's still, Scott, I don't have a ton new, unfortunately. There's still a lot that we're waiting on. I mean, June 9th is another large date, we continue to believe that, we think that we could see additional delays here. And we think that the department will ultimately look to potentially revise parts of the rule, not make it as onerous, potentially take a lot of the litigation and risk out of it. That's one person's opinion, maybe one legal team's opinion at Athene as well. With us until June 9, it's business as usual. Listen, we are prepared to enact procedures and disclosures for you all to sign, and we'll coach you through that if this goes into effect as is on June 9 or beyond. But we don't think that's going to happen at this point. But again, just keep your ears to the ground and make sure you're aligning yourselves with an IMO, like an IAMS, for instance, that is plugged in as things change. Because literally every week or two, anyway, that goes by, we're getting updates or revisions potentially. So, at Athene, it's business as usual. We are going to be keeping a close eye as over the next 2 months how things develop, but we're still positive. We're still feeling pretty optimistic that it'll fall the way I think most of us want it to fall. It just may take us a little time to get there. So, again, with that said, just make sure you're aligning yourselves with an IMO that's prepared as well. So, I think again, I would put IAMS on that short list certainly. So Scott, wish I could give you more specifics, but again, the delay document is still pretty fresh, and I know our legal team is still reviewing it and going to get their commentary there eventually. But hopefully, that gives you a sense of where we're at.
Absolutely,
at least some sense.
Yeah. I don't. That is. This sounds bad when I say it, but I don't mean it in a bad way. That's the type of answer I expected to those questions. I mean, just to expand on what Max said a little bit, and then we're coming up at the end of our hour. So I'm going to make these last comments and then we'll sign off. I know a couple questions came in late. We will get you the answer to those questions here today as well. But to expand a bit on the Department of Labor ruling and what Max said, nobody knows what's going to happen right now. We do know we have a 60-day delay for sure to June 9th for implementation date. And that is ever changing and ever evolving. If you are not preparing yourself as if this will go into effect, I would say give me a call. Let's have a conversation, because unless your plan is, if the DOL goes into effect, I'm going to retire or semi-retire and not work with qualified funds, you need to have a plan in place just in case. We can certainly help you develop that plan. We can show you what your options would be, making the assumption that it goes into effect as written. And make sure that you're aligning yourself with carriers that are on the forefront of this and do have their procedures in place for if it happens, such as Athene. As Mac alluded to, if the June 9th date comes and it goes into effect, we might not think it's going to happen that way, but let's say it does. Athene, and I've seen some of these documents, has everything in place to just, boom, the calendar flips and here we go. Now we can write business. So make sure you're looking at that and looking at your practice, with a good, hard, take it seriously, put it that way. That being said, we are at the end of our hour, so I do want to thank you all for taking the time to join us. Mac, I want to thank you for your time. I know it's very busy for you, so we do greatly appreciate it. Any parting words for the group?
No, again, thanks for the time that you've allotted to us today. And, if you have questions, call Scott and his team, call my team. We look forward to working with you. Have a great day.
Absolutely. Again, thank you, Mac, and to everyone that took an hour out of your day to join us. I know an hour with us on a presentation is an hour where you're not out prospecting and selling, so we do greatly appreciate that and value your time. Thank you so much, everyone. Go out, have a great sales day, and I look forward to speaking with you all in the very near future.